Very much, Carmelo. And first off, thank you to you and Alex for inviting me on. And yeah, as Carmelo said, we're gonna be talking a little bit about the world of alternative lending today, right? Not only what it is, but more importantly, why it's not just a relevant or viable option, but in my opinion, an absolutely necessary one. So before we jump into the presentation, I do want to give a little bit of background on myself. I do have about 8 years in the industry, and the first 6 of it was spent at a lender that did both prime and alternative lending. So my focus then really was on policy, right? The requirements surrounding who we wanted to lend to on both the prime and the alternative space. So what that did was it gave me a fairly unique perspective on not just the mechanisms behind the two types of lending, but the mentality behind it as well. And really, it's the second part that we're going to be focusing on. So with that in mind, I'm going to try sharing my screen now. Let me see if this works. So it says that I'm presenting. Can everybody see it?
Yep, you're good. You're good, Eton.
Perfect. Thank you, Alex. So first off, right, what exactly is alternative lending for those who might not be familiar with that term? So this slide basically represents the mortgage landscape as we see it today, right? So on this graph, on the x-axis, you see what I call flexibility, and on the y-axis going up and down, we see pricing. So on the left bottom corner, we see A lending, right? So that is generally lending that's offered by banks and other large monoline lenders where their pricing is the most advantageous. But correspondingly, their product features tend to be exactly what they say. And so their flexibility might not be as much. The next level up, we have alternative lending, right? And alternative lending is where the pricing is a little bit higher, right? But it comes with additional flexibility. And finally, we have what is called private lending. Some people would call that the Wild West of mortgages, where the pricing is high, but the flexibility is also unmatched. Now, private lending is outside the scope of our presentation today. And our discussion really is going to be focusing on A lending and alternative lending and the relationship really between the two. And to go back to the initial question that I asked in the beginning, why do we say alternative lending isn't only relevant, but necessary? So to answer that question, we're actually going to go back in time. And the year that we're going to go back to is 2012. Now, 2012 was a very prosperous time for a good many homeowners. So if we were to think back, what was the world like then? So in 2008, the world was swept by an economic crisis that originated in the US. Now, thankfully, Canada's financial infrastructure was robust enough to withstand the worst of that crisis. And really, much of that was due to the way that banks and other lending institutions were regulated. Now, that being said, Canada still wasn't completely immune to the fallout of that crisis. And it took us some time to recover from that. Now, by the time we got to 2012, Canada was well on its way to recovery. And for those who paid attention to such things back then, rates were very low, right? We're talking high 2s, low 3s, much lower than they are today. And in addition to that, the rules surrounding how to qualify for a mortgage were also much, much easier. So without getting into the nitty-gritty of it, right? The way that lenders qualify customers for mortgages is they will compare your mortgage payment, which is largely dependent on the rate, and they will compare it to the income that we earn. So I'm a visual learner, so I brought some props to use with me today. And so what we're going to do is we're going to represent income with this hoop here, right? It says income on it. And we're also going to represent payment with this ball, right? Which, as I said, is largely dependent on the rate. And as we said, rates back then were about 3%-ish. So as long as this ball can fit into this hoop, the lender or the bank, whatever the case may be, will approve the mortgage application. So back in 2012, every single ball fit into every single person's income hoop for the most part. And so back then, not only were people buying their primary residence, the home that they lived in, they were also buying a rental, a second rental, sometimes even a third one. And in fact, we were getting month after record month of activity. And as a result of that, as you can see on the slide, property values also went up. So it can be argued that property prices going up is a double-edged sword, because on one hand, it did make it more difficult for a number of homeowners, such as millennials like myself, to enter the market, although the low rates at that time did help. On the other hand, for those who already owned homes, they saw their equity and hence their wealth skyrocket. And so all in all, it was a fairly good time. So if we were to visualize the difficulty involved in entering into the A-lending space at the time, we could visualize it kind of like this, right? It was a low wall, very easy even for a single person to just climb right on that wall. And if you had a working spouse or a common law partner, then it was made even easier. Now, let's fast forward to 2016. And if you were to ask any mortgage professional, they will tell you unanimously that this was a turning point in the mortgage landscape. Because this was the year when the government of Canada decided to implement something called the stress test. Now, the stress test, in simple terms, is the government requiring that we add 2% to whatever rate the lender is offering you at that time, in essence, to pretend that your payment is higher. So going back to our previous example, if that lender offered you a 3% rate, that's the rate you're paying, the government requires you to qualify at a rate of 5%. So going back to our ball and hoop example, right? You see the hoop representing our income hasn't really changed that much. But now the payment, the ball representing the payment, that's gotten a little bigger. And you see, if you were to put this ball in the hoop, it's a bit of a snugger fit, right? And if your income hoop wasn't that big to begin with, then you might not even qualify for a mortgage anymore. And so what that means is a mortgage application that previously could have been approved pre-stress test might no longer be approved under the stress test mechanism. Now, back in 2016, though, not every single mortgage was affected. Now, at that time, the stress test only applied to what we call insured mortgages. So that applies to mortgages on properties that had less than 20% down payment. If you got a mortgage where you were able to put down 20% or more, which we generally call conventional mortgages, then you were not subject to that stress test. So going back to the same visual as before, we now have a slightly higher wall to climb over if we want to enter that A-lending space. So it is more difficult, but not impossible, right? If you were still a strong person financially, you could still get into that space with relative ease. Now, let's jump ahead another 2 years into 2018. And again, we have the stress test. Now, this slide is not a mistake. It's not repeat on accident, because in 2018, we did encounter this stress test again, except this time it applies to all mortgages. So now, every single potential borrower, regardless of how much income you made, what your credit background is, and how much you're willing to put down on that mortgage, you are subject to the stress test. And so, logically speaking, if 100% of borrowers are now subject to the stress test, then naturally the barrier of entry into A-lending is now even higher. And as you can see, it would now start to get difficult for a single person to scale that wall. Most people would need at least one other person to help them get there. Now, keep in mind at this point, rates were still relatively reasonable, right? We were still hovering around the high twos, low threes, which means the borrowers had to qualify on payments based on 4 and 5%. And as we showed in this example, still achievable. Now, what about today? Now, starting near the end of 2021, rates have increased dramatically at a pace that Canada has not seen for over 2 decades. Now, as of today, rates are hovering around 6 to 7%, which means customers now have to qualify in the 8s and 9s. So now our ball representing income has increased to colossal proportions. And for the most part, for a good number of borrowers, this payment simply does not fit into the hoop anymore. And so what do you get when you combine the stress test with high rates, along with incomes that are not increasing as quickly as expenses? Well, you get this, a dauntingly high wall that is virtually unscalable by the average family without some form of assistance. And so it goes without saying that A lending, for a while at least, became out of reach for a significant number of borrowers. Now, one thing we want to notice is as we progressed throughout this wall analogy, as that wall got higher and higher, the borrowers didn't really change much, right? We're not talking about people who lost jobs. We're not talking about people who went into bankruptcy or had any serious credit difficulties. We're just talking about average folks like you and me. So the fact that A lending isn't achievable by everyone nowadays is no fault of the borrowers. It is simply the fact that both the mortgage and the real estate landscapes have shifted beneath our feet. So at this point, we can go back to the question that we asked at the beginning. Why do we say that alternative lending is not only relevant, but necessary? Well, what is one thing that we can think of that makes a high wall like this less intimidating? Well, a ladder would really help. Now, with this ladder, by taking things one rung at a time, we can eventually scale that wall and get to where we want to be. And I'm sure quite a few of you can guess where I'm going with this, but the ladder in all of this is alternative lending. Now, let's take a moment to think about a literal ladder, right? We use it to get from point A to point B. Very rarely does anyone get on a ladder and think, wow, this is absolutely amazing. Let's try to stay on this ladder as long as we possibly can, right? And of course not. A ladder is simply a stepping stone, right? Something temporary that will get us to a better place. So the same can really be said about alternative lending. The idea really isn't to stay in this space forever. The idea is to use alternative lending as a stepping stone to get to A lending eventually. Now, how long that will take obviously depends on the parameters of the borrower and their specific situation. But the point is this: alternative lending is not here to hold you back, but really to propel you forward. Now, not all alternative lending was created equal either. And we can think of alternative lending like a spectrum, right? The closer that you get to A, the better your pricing will be. But the requirements surrounding how to get that loan will correspondingly be higher. Or if you're a little bit farther from A lending at the moment, that's okay. You might have to take a slightly higher price, again, for the time being, but the requirements surrounding how you secure that loan will also correspondingly be lower as well. And so one thing that we want to take away is that we don't ever want a customer to feel helpless, right? There is a mortgage for you. And as long as you have a plan as to where you want to be in 5 or 10 years, the mortgage professionals like Carmelo and Alex will have tools to help you get there. Now, where exactly does NPX fall, right? We fall right around here. We do offer better pricing, and to many people, they think that as far as alternative lending is concerned, meeting our slightly higher requirements is worth the benefit of that pricing. Now, specifically, how does NPX help you? Now, over the course of this presentation, we mentioned something repeatedly called the stress test, where we have to add 2% on top of whatever rate the lender is offering to qualify. Well, at NPX, we have options that can bypass the stress test. And what that means is, if we were to offer you, let's say, a rate of 6 and change, we would qualify you right at that. Whereas another alternative lender might need to qualify you at 8 and change if they were to offer you a similar rate. So, this example is fine and dandy in theory, but how exactly does it look in terms of real numbers? Well, the next slide is designed to help us see that comparison. So in this example, we're going to take a look at a family that combines in $100,000 in income. And we're also going to pretend that they pay $3,500 in annual property taxes and a 150 monthly income. We're going to compare this customer, how much they qualify for at a stress-tested lender who offers about 6.5 and qualifies at 8.5, versus NPX that's at this moment offering and qualifying at 6.94. Here is that comparison. At a stress test lender, this family will qualify for a loan amount of about, let's say, $370,000. Now, without augmenting this family's income in any way, without adding dad or grandpa or uncle to go on title, and without having to pay down their debts using their own savings, just on merit of bypassing that stress test, we see now that this same family qualifies for a loan amount of about $430,000, right? A $70,000 difference in the loan amount that they qualify for. Now, if you're looking to purchase, what does that mean for you? Well, it potentially means that you could upgrade, let's say, from a condo to a townhome, or from a townhome to a single family dwelling. But where this could really come in handy for you is where it comes to refinances. Now, every quarter, CMHC, which is the Canada Housing and Mortgage Corporation, they publish a report. And as of spring 2023, the average debt to income ratio for the average Canadian is 171.9%. And that means for the average Canadian, for every dollar of income that they earn, they owe $1.72 of debt. And a good portion of that is unsecured debt where they're paying double-digit interest rates. So by having NPX as an option, if you're looking to refinance, you now have a choice. You could take that slightly lower interest rate at 6.59, qualify for 370, pay out whatever debts you can at that loan amount, and maybe you still have $10,000, $15,000, $20,000 of revolving debt where you're paying 19, 24, 29%. Alternatively, you could consider an NPX mortgage and get rid of all of that revolving debt in one go. And any mortgage professional will tell you that the number one killer of cash flow is not the mortgage. Because every time you pay your mortgage, you're getting something back. You're building your equity. You're building your wealth. However, if you're only making the minimum interest payments on a credit card, that doesn't achieve the same effect. So under this non-stress tested option, not only can you stop your short-term cash flow bleeding, it actually allows you to reach your long-term goals faster. And that is a tremendous value add. So how exactly can you benefit from NPX? Well, the way that my company is structured, we do not deal with end customers directly. we do rely on trusted mortgage professionals like Carmelo, like Alex, to first talk to the customer, assess their needs. And if your needs align to what NPX can offer, then Carmelo will assist you, or Alex will assist you every step of the way until that mortgage is funded. So if anything resonated with you today, and you're certainly welcome to ask me questions, afterwards, but if in a few days later you have questions about NPX, you have questions about, non-stress tests and how it could benefit you, my best advice is to reach out to Carmelo, reach out to Alex, because they're really in a position to answer all of those questions for you. So this basically concludes my presentation. I sincerely hope that those who played were able to pick up one or two things that resonated with you. And yeah, at this point, I can either hand it back to Carmelo or start taking questions. I think Alex has a hand up, right? Oh, I think you're muted.
You're muted, Alex.
Yeah, sorry about that. So yeah, Eton, I do have a question. First of all, excellent presentation, and thank you so much for, the way that you present the data. It's very easy to understand. So thank you so much for that. So I mean, I guess that slide where you showed somebody being able to qualify for a higher mortgage amount. So I guess by eliminating that stress test, somebody can potentially purchase a property that's 20% more in value. Is that roughly kind of like a good way to look at it?
That's precisely right. Obviously, it depends on the income that they actually earn.
Yeah,
but that's a great way of looking at it.
Yeah, because I mean, like this example, there's no, like these are. I understand that you're just using these numbers for simplicity and the $100,000 income, but just like I'm thinking about how does this example look for somebody that's looking to buy a property in the GTA for substantially higher purchase price than $400,000.
Right.
Yeah, but yeah, excellent. Thank you so much.
Oh, thank you for that feedback, Alex. Appreciate it.
Yeah. If there's any questions from the floor, feel free. You can either raise your hand, you can unmute yourself, or you can just type it in the chat. I'm going to also share a link in the chat in about a minute. It's just a link for Calendly if anybody wants to book a call with Carmelo to discuss any questions that they maybe don't want to share during the presentation. Then Carmelo or myself will be happy to do that.
So Eton, excellent presentation. I actually want to add too, when it comes to like the refinancing, because I see a lot of it, and that's why I call you sometimes about this product. Even those who may want that lower rate, sometimes it's leaving that unsecured debt of 30, 40,000 will actually prevents them from qualifying as well. Because you got to qualify for that mortgage, but then the bank still needs to know you have income to support the other debts that you have. And if it's I've seen cases where it's an extra 30, 40,000 that's not being added and refinanced into the mortgage, but it prevents someone from then qualifying for that mortgage as well.
Yeah, that's a great point, right? Because lenders have a very specific way of calculating unsecured debt, and believe me, it is not generous. So being able to get rid of that is a huge help.
Yeah, and like you said, again, it's like when you put out all your payments, when you have life happens. We've all gone through it. I've personally gone through it once, where you just have like multiple things happening,
Yep.
One-time events, and all of a sudden the bills rack up. When you consolidate everything into one payment versus having 3 to 5 to 6 different payments, life actually relieves a lot of stress too, because now you're not wondering, okay, it's which bill do I have to pay this Friday? I got to just make one payment. Everything's combined into one. All of a sudden, the stress levels come down.
Yep.
Health goes up. Sleep better at night, and even most importantly, the cash flow increases.
That's right.
The minimum payments on credit cards are usually 3% of the balance. So if your balance is $10,000 and you have a $300 payment, then let's just say you got a total of $40,000 worth of mixed debts. That's an extra $1,200 per month. When you just add that to your mortgage and you only see your mortgage payments go up by $500,
yep.
Now you have an extra $700 to it's relief. You don't have to go into debt anymore. And I've had people where I coach them to use a portion of that to actually help them increase your payments or put a lump sum at the end of the year to pay it off faster.
That's absolutely true. 100%.
I think we were talking before we went live here with the call just about how there's so many different opportunities out there available for consumers with different products and ways to use equity for examples like what you guys just talked about. I mean, that's it's a great way to use equity, pay, consolidate everything, pay a lower interest rate, and give yourself some breathing room. So that's amazing. So guys, if there are any questions from the floor? Doesn't look like there is. So yeah, I did share our Calendly link there. So I guess, Eton, if there's no questions, that means you did a really great job explaining your topic.
Awesome. Well, again, I just really want to thank you and Carmelo again for inviting me here. I always have a blast talking about NPX, and really every time I go through this presentation, it's a trip down memory lane, right? To think how things used to be and how competitive to how things are, and hopefully 2024 looks, at least for now, the projections look to be a lot better than what we had this year. So a lot of reasons to be optimistic going forward.